Hey everyone, welcome to another edition of the Buddy Study Group. And today we're very happy to be joined by Kim Lipps from John Hancock. And she is going to take us through a product that many of you have gotten a hold of me and requested that we have a study group session for. So your wish is our command, and we're going to be going through John Hancock's new LifeCare product. So a new entry into the hybrid long-term care market from a carrier who is very, very familiar to the space and who I'm sure many of you know and still work with today. And I won't give any more spoilers. I'll let Kim take it from here. Kim, we really appreciate you being here for us today and giving us the info we need on this product.
Well, thank you so much, Jason, for letting me join your group. I love telling our life care story. So I'm going to go ahead and share my screen and jump right in. It's my understanding that we are going to put any questions throughout in the chat, and then Jason will let me know if they're pertinent to the topic that we're talking about at the time. He'll interrupt, and we'll try to answer those as we go. And then anything else we'll just save till the end. So thanks everybody for having an interest in life care and learning more about our modern and innovative take on a hybrid product. So let's just start off here with the background and the pillars of our life care product. So before our leadership team, it decided to invest the dollars and the time and energy into developing a hybrid product, they did put together a team to go out and survey the seven largest distributors of hybrid products nationally. And the first question was, is there room for another carrier in this space? Unanimously, they all said yes. A couple did give a disclaimer and said yes, as long as it doesn't look exactly like everything else that's already out there in the hybrid space. So, of course, the follow-up question was, well, what would you want to see different? And there were three key things that popped up from almost all the carriers. One was a more meaningful death benefit. Another one was for us to offer both indemnity and reimbursement. And the third request was for us to come up with an innovation to better address the rising cost of home health care. So I'm sure that most of you on this call follow the Genworth cost of care study. I love that they still publish it annually, even though they haven't been in the space for a while. But if you have been following that, you know that over the past prior 3 years, home health care costs have been going up at an inflation rate of 10% annually. So that traditional 3% compound that we've typically been illustrating on hybrid products is just not going to keep up with that rising cost of home care. So we've come up with an innovation, and I'm going to address that in pillar number one on the screen. So that's more growth potential. So first of all, let's start out with the fact that our death benefit grows. So the life care death benefit will start out similarly to the other carriers in this space that you're used to, but the differentiator is it does grow. What that means is that we believe you'll organically be able to grow your hybrid sales simply because you'll be able to bring more presentations to the finish line, aka the application, right? That's going to be because you're going to have clients who maybe don't foresee themselves needing long-term care or haven't had personal experiences with their family members. And so therefore they're not finding value with the death benefits being provided on traditional long-term care or even hybrid products, right? The IRR that you'll find and the internal rate of return that you'll find on our death benefit for the premiums put in are really competitive. They're meaningful, and therefore, receiving three, sometimes even four times as much death benefit at life expectancy compared to what you've been used to showing them with our other peers in this space is going to help you close more sales. Now, we put it on an indexed UL chassis. All right. We did that so that we could address that ask about growing the benefits in a more meaningful way. So we don't even offer a 3% compound inflation option on life care. Instead, we are tracking the S&P 500. All right. We're doing that because historically we know that it's going to return something more than 3% as an average over an extended period of time. And with that, then we can grow those benefits more meaningful. We'll look and dig into that in a little bit more detail. But let's pivot to pillar number two, more healthy days. That's our Vitality story, which is a wellness program. So, most clients that you're going to be having these conversations with about longevity or long-term care planning are going to be familiar with wellness programs. And the reason for it is many of them have a wellness program on their group health insurance policy. Very mainstream, especially with larger employers. That's all that Vitality is. It's a wellness program that incentivizes the clients for taking healthy steps to live that healthier lifestyle. So doing preventative health exams and submitting that once a year, just like they do for their group health insurance plan for their employer, wearing a wearable device and tracking their steps, things of that nature earn them points and therefore statuses for a credit to the death benefit. So each year that they engage in the wellness program, it's a credit to the death benefit. And as a result, also growing the LTC benefits as well. We'll look at an example of that. Number three, more choice. Lots of choices. First of all, I did allude to earlier the request for indemnity and reimbursement. We did fulfill that, and we offer both indemnity and reimbursement. The way it works, we will automatically pay cash indemnity from day one unless they request reimbursement. We have made the cash indemnity our default method of payout, but they can request, as I said, the reimbursement model. If they choose to continue with the indemnity, we will pay indemnity benefits up to the IRS per diem limit in the year of claim. Okay. Once they have maxed out on that IRS per diem limit, if their monthly maximum LTC benefit is greater than the per diem limit, and if they are receiving qualified care that's over the per diem limit, we will then pivot them to reimbursement to access the remainder of that benefit. I have an example if we have time to go through it, but hopefully that makes sense to everybody. So indemnity up to the per diem limit, then we pivot to reimbursement. It's simply a consumer protection feature. We'd like to think that every agent out there is having the conversation about what happens with the 1099s that we're required to send to the clients for benefits paid out and the supplemental, tax form that's required to be filed with their federal tax return. But of course, we know that not every advisor and agent is having that conversation. We also know that lots of years pass, even for those that are, from the time they have the conversation to the time of claim. So we're just doing the due diligence to protect the consumers and their families from any surprises up front. The other thing I want to point out is if they choose indemnity, we do not charge them for that indemnity benefit. So if they have a $10,000 a month LTC benefit, they'll receive $10,000 a month from us, whether they choose indemnity or reimbursement. We do offer 4 payment options, a single pay, 5, 10, and 15 pay. There's no age cap on any of those. So we issue through age 75. A 75-year-old could choose a 15 pay. The scenario where I've had that come up a couple of different times recently has been the financial advisor is recommending that they use their RMDs to pay the premiums for the LTC solution. In those situations, obviously, they want to stretch those payments out over a longer period of time. So our 15 pay is attractive for that, and we don't have an age cap there. I'm going to pivot over to number 4, more tax favored treatment. More to come on this because our advanced markets team has put together a tax guide and working on a couple of other one-pagers for the business owner space. But I just want to let you all know that we did include a separate identifiable long-term care premium. Next, the last one, number 5. That's simply the John Hancock story. Jason alluded to the brand recognition. We are known in this space, right? Not only do we have strong financials, but of all the carriers offering a long-term care solution today, we actually have the longest history in it. We're about to celebrate 40 years. So because of that and all those years, we're paying out over $6 million a day to policyholders and in our standalone LTC claims department. So it's a well-oiled machine. We have an online portal for completing the claim and uploading forms. All of our claim staff are John Hancock employees. We don't source or contract any of that out. They're also all based in the US. So all that's important, obviously, I'm sure this crew on this call knows when it comes to the claims experience itself. All right. Let's talk a little bit more about features. So first, let's go to the top. LifeCare is approved in all states except for those listed up here at the top. So not approved in California, Connecticut, and so on. California, we all know that one's a slow state, so it'll be a while before it's approved there. We are not filing in the state of New York. Okay, no intentions to file there anytime in the near future, so it won't be available there. Rumor has it we're close in New Jersey and South Carolina, so hopefully those will launch here in the near future. As far as issue ages, our minimum issue age is 30, maximum age of 75. At time of issue, our initial death benefit is a minimum of 50,000 and a maximum of a half a million. I mentioned the premium payment options, so let's pivot over to risk classes. We do offer 3 non-smoker risk classes. Where this can really be beneficial, and hopefully you'll think of LifeCare, is when that health pre-qualification form comes back clean. We anticipate that most people are illustrating us at standard, right along with our peers in this space. But when when they are healthy clients, obviously they'll be able to get more benefits for that same standard premium because we're likely to approve them at preferred. We do offer a couples discount. Only one spouse or partner needs to be applying. It's a very broad inclusiveness for our definition. So it's not just married couples. It's also same or opposite sex couples who have lived together for at least 12 months. Even same generation family members. So you have those two sisters, they're both widowed, living together. They would qualify for our couples discount as well. And again, only one needs to apply. So as far as benefit periods, we offer 3. We offer a 2-year, 4-year, and 6-year benefit period. The 4-year is bolded because that is our sweet spot for pricing. Again, trying not to look like everybody else out there and knowing that a couple of the main carriers in the space are competitively priced in the 6-year space, we went for the 4-year space. What does this mean? It means asking the question and coaching those advisors or agents that you might work for if you're not the agent to ask this very important question of their clients. And that is, what is your personal experience with family members needing long-term care? That's important because that's really how most clients that you're having this conversation with envision what their care is going to look like. They don't have anything else to compare it to, right? Other than their own family experiences. So it really helps me when I know the answer to that question, know how to design the benefits. And it should help you decide which carrier to go with, right? So if, the answer is, oh my goodness, my grandmother needed care for 10 years, 8 of those in memory care because she had Alzheimer's, and maybe, mom's on year number 5 of needing care. That person's, if affordable, is probably going to want that larger bucket of money, right? So 6-year benefit period, absolutely, we get that's where you're going to want to pivot. But if the answer is that they have no personal experiences with family members needing care, or those experiences are shorter term, right? Something under 3 years, we should definitely be the carrier that you're thinking of because they'll be able to get more benefits out of the policy between the LTC and the death benefit. And I'll go through an example of that with you here in a bit. Okay, so let's talk about how the benefits grow. So I mentioned early on that our benefits are growing and tracking the S&P 500. So we do offer 3 different index options available. The select capped, the one here on the top on this right-hand chart, is the default in all illustration systems, whether you're using our proprietary software, WinFlex, or Insight. It's always the select capped is the default. There is no index charge for our select capped. The cap on that index is 8%. It has a 100% participation rate, and we have a contractually guaranteed multiplier of 32%. All right. We wanted to go with a lower illustrative rate just because of the nature and conservativeness of this product. That's why our cap on this is lower than what maybe you've seen or are used to with traditional life products. Okay. We went with a lower cap, but the multiplier is higher. So again, the multiplier is guaranteed. The high capped, another option. This one does have an index charge of 1.98%. Okay. It has a higher cap, higher multiplier, higher illustrative rate. Unless you or a producer you're working with is a fan of managed volatilities, probably not going to use the Barclays option very often, but it's there if you want it. And then very noteworthy is that our fixed account crediting rate is 5.6%. So When do you use which? Here's my recommendation. If they're between the ages of 50 to 65, I think just sticking 100% with the select capped is the great way to go. But if they're under 50, really taking advantage of the growth opportunity with the high capped is a good idea. So I'd probably split, if they're under 50, the allocation 50% between the select capped and 50% between the high capped. Now, if they're over 65, I think it's a great idea to incorporate some of our fixed account. So maybe 75% select capped, 25% fixed account. Once they hit 75, maybe splitting it 50-50 between the select capped and the fixed account. But not a lot of, rebalancing that needs to be done there over the long haul. Just some of those different age categories based upon suitability.
Hey Kim, we had a question if you could just explain the guaranteed multiplier column there and what
Yep.
that means for each account.
Yep, I will. So it basically whatever the S&P does in that year, it we take that and then multiply it by 1.32. And that's what gets credited to the policy. Now, in any year where the S&P does performs higher than our cap, we're going to just take the cap of 8% and multiply it by the 1.32. And I actually have a 20-year back testing example that I'll show you here in a couple of slides to explain that better for you. Okay, so this is just a visual overview of how benefits will grow in relation to performance with the S&P. So you can see here in year one, the S&P 500 segment, which is a 12-month segment, is up at the end of that 12 months. The blue line is the death benefit. So at the end of that 12 months, you'll see that a credit or an increase happens with the death benefit because of the positive performance with the S&P. The next year, you can see that the S&P was down point to point. But you see the blue line for the death benefit remains level. That's because we have what's called an annual benefit lock guarantee. It is contractually guaranteed that once there is a credit that takes place with the death benefit and hence the LTC benefits, it can never come back down. Even though we're on an IUL chassis, all of the initial benefits are guaranteed for lifetime to age 125, okay? As well, anytime there is growth that happens in the policy, that growth is the new high water mark. It's locked in to age 125. Any questions that popped up, Jason, on this visual? Otherwise, I'm going to go to that chart that I mentioned that'll give a better idea of how the multipliers work.
None on this specifically. Let's see. Somebody somebody put in the chat, so it's acting like an FIA. Would you say that is
It's
a
an index,
decent
right?
comparison?
So
Yeah.
an indexed annuity, yep, and an indexed hybrid product, right? Absolutely.
I find this chart extremely helpful for
This is my
your
favorite
IUL
page of our
products.
illustration. Absolutely my favorite page of the illustration. I recommend using it. This is 20-year back testing. The point to point that we're using is December 14th to December 14th. So if we look up here at the very top row from 2004 to 2005, it's taking what did the S&P actually do from December 14th, 2004 to December 14th, 2005. And you can see that the S&P real world performed at 5.76%. Now, we have that guaranteed multiplier of 32%, right? So in the select cap, we take 5.76 times 1.32, that equals 7.6. That's what we actually credit to the LifeCare product that year. The next year, S&P did 12%. That's greater than our cap of 8%. So in that year, we're going to take the 8% times 1.32, that equals 10.56. So that's what we would credit that year to the policy. The next year, S&P did 2.98. 2.98 times the 1.32 equals the 3.93. The next year, oh yeah, that's '08 negative, right? So we have a floor. It's a 0% floor with our indexes. So no credit whatsoever. And even though the S&P was negative, remember, whatever level the death benefit and LTC benefits had grown to be, they remain at that high water mark. So you can see as you scroll down this select cap column, there's a lot of years of 10.56, right? that's all those years where the S&P hit the cap. What's most important is to look at the average at the very bottom. So you can see the S&P 500 real world over those 20 years averaged the 9.5% over those, annually over the 20 years. But we would have credited into the select capped 7.51% per year on average with the back testing over those 20 years. So when that's a lot different than the 5.21% that we're actually illustrating when we're illustrating the select capped, right? So when you look at one of our illustrations, what you want to help the client understand is this is a very conservative illustration. We actually expect in real world performance that your benefits can grow to be more than what you see here. And that's different from what you're used to saying, where with our peers, when you illustrate a 3%, whether it's simple or compound, you're guaranteeing them that what's on the illustration is never going to be more than that, right? That's what they're going to have. With this, they actually have potential to grow these benefits in a more meaningful way, either through the S&P growth or by engaging in the wellness program.
We've got a few good questions. Diane, if you're with us, do you want to unmute and ask your questions? Yeah, the first one I understand might be hard to ask just through typing.
Yeah. Yeah. So the first one is on the previous slide. In year three, there's just a little bit of an increase, and is that because the credit is going to catch up and because there was a negative in year two, it's got to catch up, and then you get a smaller credit, even though the market is higher?
And that is such a fantastic question and very intuitive on your part. So, the reason that it is smaller, it can be a couple of reasons, but the reason in this, we'll just explain it to you. There are policy charges that come out, and so there's a formula that's based off of the cash value growth, even though there's a zero floor, so the cash value itself doesn't ever go down, even when there's negative performance with the S&P. We do still take the policy charges that are just built in, right? Mortality charges, cost of insurance type charges, those still come out of the policy. So in that year where we did not have any growth credited because the S&P was negative, the policy charges still came out. And so now we have another year of those charges that come out, right? So there's 2 years of policy charges that need to come out. And that's why exactly you're seeing
Okay.
that illustrated as not quite as large a growth as in the other years. Very good question.
Okay, thank you. Yeah, and then the second question was on the other page you just showed us, there's a 10.56 or whatever. Does that apply to the cash value and to the long-term care
It
value?
does.
It's
It
to
sure
both.
does.
Okay,
Yeah.
thank
Then
you.
we had
Death benefit, long-term care benefits, cash value. You
All of
got
it.
it.
Wow, that's
okay,
Hmm.
pretty.
okay, awesome. And then um, Chris, I hope that answered your question. Chris was asking about kind of in what capacity do you really use this slide? I think beyond what Kim was saying about kind of showing how the illustration is conservative versus historical performance, it does also kind of give people an idea of how index universal life works if they haven't been exposed to it before. There are folks who can kind of be nervous about, hey, what if, the market completely tanks on us here? Is my policy going to completely tank? I think it helps people understand the zero floor and what you get in certain years based on performance. There's a nice spread of performance in here that you can kind of show people, and it shows how the policy would kind of stack up and perform during those years. I think that's where I see the value, but Kim, if you have any other kind of insights to provide there, it'd be great.
That's a great explanation, Jason. And the other thing that I've actually had several financial advisors reassure me of is that their clients, the general population where you're having these conversations, they're familiar with the S&P 500 simply because they already own it someplace in their portfolio, whether it be their 401k, their IRA, their, individual brokerage account. So the S&P 500 is not something that's new. And that's really why we went with the S&P. It's just really probably the most well recognized index for in the investment world out there. And so the general population's familiar with it and likely, again, already owns it. So not something that you have to delve into conversation wise in depth with them. They're familiar.
Yeah, and Chris, to just follow up to your question, then I'll get to Phyllis's question. the slide itself may not be used with the public, but what you're seeing here is actually a snippet from a real life illustration that the client would have made for them as part of the planning process. So you
It's
could
page
show them
12
this.
of
Yep.
every illustration out there.
Yep.
Yep.
And then Phyllis was asking the 10.5% column, that is before the annual fees, right? Or before the charges that for the 10.5.
There is no index charge on the select capped, but there is an index charge that needs to come out over here on the high capped.
So the numbers we're seeing is before that has come out or after.
Before. So there's no index charge at all on the select cap. So this is your net. You need to subtract the 1.98 over here on the right with the high capped because the 1.98 index charge is not out.
Perfect. And Linda, do you want to share what you shared with me in the chat? I think that's
Yeah.
definitely useful
Yeah,
info.
certainly. So it's important to understand that point to point is a little bit of a roulette system, right? So because on the December 14th, the market might be up. On December 15th, the market may be down, right? So still highly valuable, right? But you got to be aware that, this is 1 point to 1 point, and one day later or one day before, because markets go up and down, you could just have bad luck, right? And the market could be up 20% one year and you pick the wrong dates and you could actually lose. So or in this case have no gains. So it's just important to have your own, when you look at these numbers, to always in the back of your mind know that there's no guarantees to any of this, and it's a
Yep. And
variable.
Linda, I'm so glad you brought this up because it brings to point something that I really like to reiterate with everyone, especially with single pays. Even somebody's paying semi-annual. Please dollar cost average. Okay. Here's the reason why. Just to Linda's point, it's a point to point, all right, and it doesn't get purchased until after the policy is already in force. So when the client gets their first policy annual statement, that 12-month segment is not going to mature until after the first policy anniversary, unless you're putting them in the fixed account. And then they'll have growth over that first policy year. So whenever you're doing a single pay, for sure, when you're doing the e-app, please elect dollar cost averaging. What that means is that we will put that single pay into our fixed account, earning that 5.6%. And then each month, we're going to take 1/12th, 1/11th, 1/10th, 1/9th, right, of what's remaining out and put it into whichever index you had allocated it to. So just assume you're allocating it to the select cap. So what ends up happening, and this is just investing 101, right? With dollar cost averaging, they're going to end up owning 12 segments, which is going to reduce the chances that over a 12-month period of time that they have a potential negative return in the market. So very, very important. I'm so glad you brought that up, Linda, because I probably would have forgotten to mention that you always want a dollar cost average with single pays. I would really even recommend it with your semi-annuals or your quarterly payment modes as well, because we offer it for that. Monthly obviously is already dollar cost averaging, so they'll end up with 12 segments already, but definitely recommend it with those longer payment structures.
Love
Yep.
it. That is really exciting. That's a very nice benefit to
Yep.
be able to do that.
We've got some sharps in this group, Kim, if you haven't already noticed.
Love it.
Phyllis is just asking for some explanation on the footnote about the 5% inflation each year.
Yes, yes, yes. So we do offer 5% compound inflation only on our 6-year benefit period. It's required by the regulators. Any LTC solution is required to offer a 5% compound. It's kind of that dated legislation out there. Run it on a day when you've had a really bad day and you're looking for a good laugh. the pricing is not something that I think that you'll sell. Okay. It's there. But I would never think that you're going to sell it. But again, save it for a day. You've had just a terrible day and you're looking for a laugh. That is the day you want to take a look at the LifeCare 5% compound pricing on our 6-year benefit period.
Appreciate the honesty there. So I know there's more questions. We'll get through them. We just got to make sure that Kim can get all the way through her presentation here.
Okay, let's keep going. All right, this is a comparison and a great way to help me explain when and where to position LifeCare. So this is a female, 55, doing 100,000 single pay. We are looking at Nationwide Care Matters, Lincoln's MoneyGuard Fixed Advantage. It's using their 3% compound inflation and their 6-year benefit period, right, where they're most competitively priced. It's using our 4-year benefit period where we're most competitively priced. So let's look at age 85. You can see that the monthly maximum benefit does have a difference. And let me note that both the blue and the gold bar on the right are LifeCare. The blue one assumes that they are not engaging in the wellness program. The gold one shows what engaging at a gold level in the Vitality Wellness Program can do for the benefits. So let's just focus though on the blue. So we would have at age 85 a 21,000 a month benefit. Lincoln being the closest would be 16,000. So what's the extra $5,000 access due for the client? She gets to go to a 5-star assisted living instead of a 3-star and have it all paid for, right? Or can pay for more hours of care in the home from the policy instead of out of pocket, or also prevent the family members from having to subsidize those extra hours that she might need. Of course, if she doesn't need our full 21,000 a month, maybe just needs 16,000, the extra 5,000 just stays in the policy, and now it's going to last longer than the 4 years. Over here in the middle, of course, because it's 6 versus 4, we would expect for Nationwide and Lincoln's pool of money to be larger than us. But noteworthy is if she engages in the wellness program at a gold level, that bucket of money for LTC actually does surpass the Nationwide pool of money. So I thought that was noteworthy. And then really the one I want to focus on is over on the right-hand side, and that's the death benefit. So you can see, significant growth in the death benefit over the life of the policy. Where this is going to be important and should help you truly close more cases is when the individual you're talking to or one of the individuals of the couple does not foresee themselves needing long-term care in the future. When that's the case, that person won't proceed if they don't find value in it. Or they could be a roadblock towards either spouse purchasing a policy. So having that meaningful death benefit so they can, both spouses who are looking at different focuses on what their end of life will look like, can both find value in one product. The other example I want to talk about, though, that's gotten a lot of promotion out there since we launched is those short-term claims. So let's say that she needs care for a year and a half. And during that year and a half, she accelerates $200,000 out of her policy for the cost of care. She's still got $300,000 remaining as a death benefit to pass on tax-free to her heirs. And of course, with our peers out there, certainly she'd be able to access the $200,000 to pay for her long-term care costs as well. But because she would have already accelerated the full death benefit, it would just be the residual benefit that's remaining. So when we look at the total between LTC and death benefit, she's accessing somewhere between, 210 to 220,000 in death benefit with Nationwide and Lincoln compared to $500,000 with LifeCare. So very important to know what their vision is and what their experiences are with family members needing care, because that will help them find value and will hopefully help us all in the industry get more clients insured and protected for these future needs. All right, let's take a look at this page. This is actually page 2 of all of our illustrations. So this shows how engaging in the wellness program can actually grow the death benefit and the LTC pool. So when we look down here in the gray chart, bronze assumes no engagement in the wellness program, and that's how we want you to illustrate. Path of least resistance. That way, if they don't illustrate, no harm, you've shown them these top row of benefits. But if they do decide to participate, you can see that participating at a very low level, super simple to achieve it, achieves a silver status, and that would add an extra $30,000 to the LTC pool. Should she engage at gold, that would add an extra $100,000 to the LTC pool, which is meaningful considering $100,000 is all that she put into the policy in the first place. And then at platinum level, it adds an extra, $120,000 to the LTC pool, as well as just growing the death benefit. So again, just another way for the client to be in control of the policy, engaging in it, and not just paying premiums on it for 20, 30, 40 years until they actually go on claim. All right, let's talk about benefit eligibility. So same triggers, the 2 of 6 ADLs or cognitive impairment. We have a one-time elimination period and it's 90 calendar days. Let's talk about international benefits. They've been getting a lot of buzz lately since we've been providing some clarification out there. So LifeCare allows your client to receive 100% of their total LTC benefit pool for care provided outside the U.S. on an indemnity basis. So we do pay the benefits internationally on an indemnity basis only. What that means is the insured can be paid 100% of their maximum monthly benefit amount up to the IRS per diem limit. Because remember, we cap our indemnity benefits at the per diem limit. Did any questions pop up on international benefits?
I will create one because I know Linda and I love talking international benefits because there's always a lot of questions as to how we're certifying that care or what
Oh, yeah.
care qualifies for the international benefit, or if
I
U.S.
think I'm going to
doctor
have a
is
good answer for
required.
you.
Oh, I
I think
love
you're
to
going to
hear
like
that.
it.
And Linda, anything to add to that? I know this
That's
is this
exactly the question I was going to ask.
perfect.
Perfect. Yep.
So we do require a U.S. physician to certify. However, they can do it virtually. We're not asking the client to fly back to the United States when they need long-term care to get certified. We implemented virtual certification for international coverage during COVID. So again, another positive of COVID, thinking outside the box and how can we better serve our customers.
So let me ask you, because, it sounds good. It sounds good, but functionally, when, it's one thing to use Zoom and video conferencing if you're abroad and you need an antibiotic. Very easy for a doctor to manage that. But when people move abroad, they and you're asking them for a plan of care, it's they have to I was talking to doctors and asking people to ask their physicians, would they do a plan of care internationally? And I have not found a doctor in the United States who says they would do a plan of care outside the United States because they're not licensed in the other country. They don't feel, that they feel like there's another whole that it's not something simple, that they're actually providing primary care,
I
outside
will
of the.
certainly go back and clarify how we're paying those claims then that
Okay.
have come up over the past 5 years. But
Yeah.
there are doctors either doing that or um, somebody did mention to me that their thought for their parent that has a policy with us and needing care internationally is that the international physician would be on this call with the U.S. physician to help with verifying the certification, questions, getting that done and developing the plan of care. I don't know if that would make somebody feel, a U.S. physician feel better or not, but we certainly have paid claims internationally over the past 5 years by doing it that way. So I can take that as a takeaway though, and certainly find
Yeah.
out.
And if you have answers of, of what we need to say to US physicians to give people that confidence that, and the other thing is that once people leave the United States, they don't necessarily come back every year, especially as they age, to go back to their doctors. So they lose contact with their doctors. So then it's a question of, are they really necessary
Reestablish.
to maintain it's one thing if you have a doctor for 20 years and you go abroad and you still maintain your relationship. It's another if you go abroad, you're abroad for 5 or 10 years and then you go into claim, and you don't have a relationship with a physician in the United States.
Great
Yeah.
questions. I will dig more into that. I'll send it to Jason so that he can get it out to the group.
Yeah,
Thank
I
you.
think what we just see on the international benefit side is, there's um, an announcing of the benefit, but there seems to be a lack of, say, resources or a concierge or an ally to that end to help make sure that we're able to make ends meet with the claim. So,
I get it.
any
Yeah.
any info you have related to that would be awesome. There was a question about what about a U.S. doctor at a consulate or embassy, and then are benefits paid to a U.S. bank?
We do only pay in US dollars. Yep. Only pay to US dollars to a US bank.
U.S. doctor at a consulate or embassy, you know, to me seems like it would be
Yeah.
eligible. Any thoughts there?
It's
Yeah. No, I would agree.
eligible, but just keep in mind, so I did a lot, I've been trying to do a lot of research on it, and I tried to look up doctors, international doctors in the embassy, and it's really only for crisis emergency situations. I have not found access to physicians for routine primary care, and a plan of care is a routine, you know, it's primary care as opposed to urgent care or emergency care. So if people find things differently, I am open to everything. If there's, a practice that says that they are open to this type of stuff, to be able to know that there's a practice that they can reach out to, you know, any of those things where we can actually say, we know that there's this physician service and they're happy to do this stuff, and know that there's a resource, that any of those things would make me more confident with that US certified physician.
Perfect.
Thank you.
Let's see here, time-wise. I know we're getting close, so let me scan through the last couple slides. I think everybody understands how our indemnity and reimbursement work together when the monthly maximum is over the IRS per diem limit. So I'm going to skip over that. Our concierge services are with the helper bees, so that is our vendor. They will come in and do a one-on-one consultation within the home to determine things like, do rugs need to be tucked down to prevent tripping? Where's an evaluation of where there needs to be railings and ramps installed, talking to the insured about alert systems, those types of things to help them age in place for a longer period of time, right? They'll also give referrals to home health care agencies, care providers, and some of those offer discounts when referred through the helper bees. Okay, let's talk application. We are e-app only. All right, so we're on the iGo platform or accessing it through rjhsaleshub.com. Couple things to note. If you're the producer, the agent, this is an easy one. You know that you need to get appointed up front. But we have put our agent information so that we can verify if agents are properly appointed with us as well as properly LTC certified up front before the application goes out to the client for e-signature. So worst case scenario, we're doing this check. It takes about 10 minutes behind the scenes while producer is completing all the other sections of the e-app. And then at the very end, if the appointment or the licensing is not in good order, they simply won't be able to send it to the client for signature yet. Instead, it'll pop up and say, please go to, the firm that you submit your business through, and they'll help you, get this cleared up. That's just going to prevent anybody from having to go back and get a new application because they weren't properly licensed in a state. We do require that an illustration be uploaded. All you need to do is say whether or not it's signed or not signed. Of course, we expect that most of these will probably be unsigned, so just be sure it says unsigned, and that way the illustration will actually get signed during the e-signature process. Our medical questions are done via e-interview. So this page gives gives the agent the opportunity to say that they would like the proposed insured to complete the questions or whether or not they would like to complete the questions as the agent. We don't care which one, you just have that choice. If you check the top box, that just means that the medical questions are going to be completed by the client first, and then it'll go on to allow them to complete the e-signature process. As far as underwriting, we talked about the risk classes. We are streamlined electronic underwriting. So what that means is no paramed exams or labs ever. That also means that for those clients under 60 who don't need to have a cognitive screening done, they could actually have a potential to get an instant underwriting decision. Meaning within 30 minutes of the application being released to John Hancock, the agent would receive an email with an underwriting offer. Now, that doesn't happen for every single client under 60. I wish, but it doesn't. Sometimes we do need to have an underwriter put a quick set of eyes on something that came in through the MIB or RX script check or MVR or something like that. Literally, they put their eyes on it, check the box, it goes back into the metrics to assign the risk class and send out the email with the offer. Others might need electronic health records due to some sort of a pre-existing condition. We are having fantastic turnaround time simply because we implemented at John Hancock a new process where we're contracted with multiple vendors for electronic health records. So we're receiving those in a matter of 2 to 3 business days typically. And therefore, the average turnaround time thus far in the whopping 2 months that we've had the product out has been from day we receive the application to day we issue the policy, 7 business days on average. The 1035s are throwing us off a bit, extending it, but that's just because we have to wait for that. We do have a LifeCare Quick Quotes mailbox. So LifeCare Quick Quotes at jhancock.com. Please do not attach any attachments or any personal identifiable information. It's more of a, I got a client who, had the surgery, takes these meds, things like that. And then we do require the, traditional LTC cognitive screening for anyone over 60. So 60 and over. It's a phone interview, and we're partnering with Illumifin on those. So far, again, great news on this front. It has not taken more than 48 hours for any insured or applicant so far to complete that Illumifin telephone interview. So agents are doing a great job of telling them about it, or Illumifin has a great system in place. One or the other, or a combination of the two. But I've been very pleased with our success in getting those phone interviews completed quickly. All right, so we do have a team of four Kimberlys. I cover the greater Midwest. So we are partnered with and assigned to different RVPs on our life insurance side. So these are all their territories. And then up in the right-hand corner, you'll see it's either David Bidwell, Conan McFerrin, myself, or Glenn Usher are the 4 life care specialists. So we are working with producers, distributors, all that good stuff. In order to all those different options in order to get the word out there and help you with case design and any questions you might have on the application process. So I'm going to stop right there. I do have a couple of QR codes. The one on the left is our LifeCare resources flyer. The one on the right is our landing page for our microsite for LifeCare. So I'll just leave those up there for the remainder of the Q&A.
Yeah, and just a quick note with regard to contracts. At Buddy INS, we are always insisting that you go to your BGA that you run business through for contracts. So always give your BGA the first look to that contract. If for some reason your BGA can't or is not able to provide you a contract for life care, you can send us an email and we can see about getting you a contract. But your BGA gets the first right to refusal on your contract. So please visit them first. And the slide that Kimberly shared is your best wholesaler contact depending on your territory. But I would agree with Mark in the chat. All the RVPs, including Kim, are great. I know a few from past years at other carriers as well, so a really well-rounded long-term care experience. Fun fact, Kim is one of the few that we work with on the group and individual side. at John Hancock, and we had a lot of questions. I don't know if we're going to be able to get to all of them, but one of the good ones was what all is eligible for 1035 exchange. We had somebody ask for probably the most extreme example, which I'm not sure would be if is a joint life VUL 1035, but if you could speak to like joint versus individual.
Yeah.
And if you could show the contact page again, some people are looking to find their wholesaler match there.
Yeah, and just so you know, we do go, it's not by necessarily the state you're located in, it's where your BGA, the firm that you run your business through, is located.
Perfect. Yep. So then
Okay,
1035s.
so 1035s, yeah. So I wish we could actually control what the 1035 rules are, but we don't get to. There's legislators and law out there that does that. So you can only 1035 from a life policy to our product. It can't come from an annuity. You can go the other way, life to annuity, but you can't go annuity to life. Um, it does have to be single ownership to single ownership, so you wouldn't be able to 1035 that survivorship that I know you specifically asked about. So single life to life care.
Perfect. And then just a little bit deeper on underwriting. Do you guys have any specific underwriting sweet spots where you believe you're strong? And
Oh,
there was an ask about like how you compare it to the say Nationwide, Lincoln Security, and some of the major players as
hmm.
far as underwriting. And just for me to add to it, does Vitality have any underwriting implications? I know there were some maybe slight ones with PUL, with certain health conditions, but I don't know if that's even in play anymore.
No, on none of our products, vitality does not play a factor in risk class, either making it worse or better. All of the um, improvement comes from the insured actually engaging in vitality. But as far as I love the question about niches and where we're competitive, there are two medical conditions that John Hancock has always been known for being very competitive in. It's people living with diabetes and cancer survivors. We actually in our if you scan that barcode, I'm going to put the barcode back up actually just to make sure everybody. But if you didn't get the resource flyer on the left, please do it. Our underwriting guide is in there, and so with the underwriting guide, what you'll find is that we have a whole page just about how we treat people with different types of cancer. So great resource. So please use that. But those are two things. Another thing, underwriting wise, that came up just last week was brought to my attention. We don't ask about marijuana use. So on our e-app for LifeCare. So what that means is that recreational use doesn't even come into consideration. It does not play a factor with life care. That is very different from our traditional life products. So don't go out there and tell anybody that Kimberly said that John Hancock's no longer considering recreational use. It only applies to life care, our hybrid product. But yeah, so that's actually a differentiator. Now, of course, if they're, if marijuana has been medically prescribed or it could come up obviously with like an abuse or addiction type situation, those are the scenarios where it would come into play, but recreational use is not even a question on our application.
Perfect. And then we had one question back to the illustration page of the presentation,
Hmm.
um, about the high capped column.
Okay.
So that the average from the high capped, that would be 10.6 minus 1.98 is 8.62, essentially,
You
when
got it.
all is said and
Yep.
done.
So a little over a point more than the select capped after the index charge. You're correct.
Perfect. And then we also had another question. So in a long-term care claim, death benefit is drawn first
Yep.
or okay, perfect.
Yes.
Um, you know what? I think we actually covered all the questions, but if we didn't cover yours, feel free to unmute or raise your hand and we can have Kim answer it in the last 2 minutes we've got here.
No, with 2 minutes to spare. I love
That
it.
that was that's what I like to call information dense. I think we covered just about every base we could in this hour. So,
You, you may have addressed this, so I apologize if I missed it because that was a lot of information. And by the way, really good. Thank you. I like this product. Um, but I ran some quotes while you were talking, and I noticed that at age 85, the benefits stopped growing.
Yes.
Why? What's going on there?
We just trying to keep it competitively priced. So we did benefits stop growing at 85. They don't stop when they go on claim if they go on claim prior to 85, right? So they go on claim at 80, benefits continue growing, but they no longer grow after the age of 85. You're correct there, David. And the other thing I do want to point out, since you talked about illustrating, because of the way the formula works with the on multi-pays, with crediting and growing the benefits with based upon S&P performance, I can just tell you if you spreadsheet us on a multi-pay, we will always be the lowest premium. We will always be the lowest premium and fairly significantly, okay? Because of that, there's not as much money going into our policy. So we'll never catch up at age 85 on growth. Instead, if you want to do an apples to apples comparison, it's not on solving for the premium based upon a certain monthly benefit amount. Instead, it's hard coding the premium in and solving for the benefit amount. It's only applies to multi-pays. For single pays, it doesn't come into play. You can solve whatever way you want, but on multi-pays, run one and you'll see if you hard code, let's say 7,500 a month in for the initial LTC benefit, we will most likely not catch up by age 85 on the growth. And again, it's because we're illustrating very conservatively and because our premium is going to be so much lower than our peers in that space. So instead, if you need to solve for 7,500, do it and then take whichever of our peers out there you think is the one that you would show or is the least expensive and hard code that premium into LifeCare, please. And then you'll have a comparison that makes sense. But our premium will be so much lower that it'll just never work out in the growth factor. So it's a little trick on multi-pays.
Okay, great. Thank you. It's all great.
perfect.
Appreciate it.
Yeah, so I think that covers all the questions. Kim, thank you very much for your time. This was an awesome presentation. I think we've got everything we need, and with regard to international benefit, I'll look out for what you can provide us there. But just really want to thank you for the time and for getting us up to speed on this new offering. If anybody else has any questions, again, that wholesaler contact page is your go-to. That'll be available in the recording as well. I think that's where we'll leave it. Thanks a lot for your time. Again, we really appreciate you being here with us. Thanks to everybody who joined, asked questions, contributed to the conversation. You helped make these study groups what they are. And we will see you this time next week. Thank you, everyone.
Thanks so much for having me. Take care, everyone. Bye bye.
Bye.